Hello, and a very warm welcome to the fifth episode of the Money Side Up podcast, the podcast for Australians all over the world when it comes to all things personal finance, from tax to investment planning, budgeting to property investment back home. We have got you covered. Thank you so much for joining us. As I said, our fifth episode. Incredible that we're at 5 already, but thoroughly enjoying the process. I'm Jarrad Brown, Senior Financial Planner to Australian Expats here in Singapore. And joining me today is my colleague, my friend, William Cant down in New South Wales. Welcome, Will.
Hey guys, really pumped to get into it again today. 5 episodes has come along really fast, hasn't it, Jarrad?
Absolutely. Well, before we get into it, let's keep the legal team happy. I'll let you fire away with the disclaimer if you like.
Yeah, guys. So obviously today's podcast and, all podcasts that we put out are just for general information only. Definitely don't race off the back of, the discussion today and make any drastic changes. And obviously, if you are going to consider anything, make sure you read any relevant documents like PDSs and whatnot. But it's for information only. And don't race off the back of today's conversation and make any drastic changes.
Brilliant. Well, I guess, look, now that we've got that out of the way, plenty happening in the world of finance. I mean, we're sitting here, it's, end of Q1, 2024 calendar year, obviously, heading into Q2, obviously end of financial year rapidly approaching. But I thought it was quite interesting. We've just had obviously the unemployment data come out for Feb for Australia, came in 3.7%, a little lower than everyone expected. I think the RBA sort of always likes to get a little bit cautious if that number starts creeping above 4. So probably a bit of a kick in the teeth for anyone who was hoping for that rate cut anytime soon. I mean, you and I were joking earlier, and as I sit here in Singapore and think about the long work hours of the average person in Singapore, I mean, it almost seems fitting that employment would jump quite significantly in Australia in Feb, given that nobody really seems to do any work between Melbourne Cup and Australia Day. But I mean, what are your thoughts, in all seriousness, Will, on the data?
Yeah, well, it's interesting because the RBA just held the interest rate as it is at their last meeting. And now this data has come out not long after, which, as you've stated, is quite a shock to a lot of people. People were estimating it would stay around the 4% mark, but dropped all the way down to 3.7. And I believe I saw the amount of jobs in February that Australians took up was the highest on record, not including the pandemic period. So, quite insane numbers really there. But moving forward, it does, I suppose, paint a bit of a grim case for the RBA to be maintaining rates or, not bringing in those cuts as most people have been estimating as soon as we'd like. A lot of economists are saying 2, maybe 3 cuts this year. It'll be really interesting to see what the forecast changed to now with this new unemployment data, potentially dropping that to 1 or 2 or maybe even 0. But I know, myself being a mortgage holder and like many of our clients and many people who listen to this, a lot of people are expecting a rate cut or hoping for a rate cut, I should say. So we'll definitely keep our ears to the ground and hopefully, the second half of the year, something does come along.
Absolutely. I certainly think with, even just with the sticky inflation data that we're seeing at the moment, particularly with services, services involve people, which often can really mean that inflation is, does become quite problematic, quite sticky. So, the idea that rates are going to get cut quickly, may not be on everyone's Christmas list for this year, I guess, in terms of what actually eventuates. But as you say, time will tell. I think anyone with a mortgage would love to receive a communication from their bank that the rate's finally going down. But don't even remember what they feel like, to be honest. It's been so long.
Yeah, it's a bit of an odd thing now to think about rates going down. They've gone up so much and so frequently. It'll be a very welcome surprise when we definitely get that news from the RBA that they are going down. And as I said, I think there'll be a lot of people that'll be very happy when that happens.
Absolutely. Well, look, I guess it's certainly one that we will be watching that space. Obviously, rates, unemployment data impacts the Aussie dollar as well. So, we have seen a little bit of strength in the Aussie dollar since that data did come out. Don't think it'll be anything too meaningful or too sustainable, but again, just for our expat listeners, definitely one to follow quite closely because, the RBA rate updates will certainly impact what the Aussie dollar does. I guess outside of that, the other big change coming up, which will impact a lot of our listeners, both expats and residents of Australia, are the super changes. So, Will, do you want to walk us through what's going on there?
Yeah, so new financial year's coming up from July, obviously here in Australia, and the super contribution rates are changing. So currently, the pre-tax contribution rate or concessional contribution rate is $27,500 a year. That will be increasing to $30,000 a year, and then people too potentially have the opportunity to put in more as well if they use their catch-up or the carry-forward contributions. Then we've got the post-tax type of contributions, non-concessional. Current limit for those is 110. They're increasing to $120,000 from July 1st, 2024. And again, using the bring forward provision, potential to put in 3 years worth. So from July up to $360,000 effectively tax-free into superannuation. So massive changes. We say it with our clients so regularly that super can be a great asset to use for your retirement, to grow your wealth tax effectively, and then in retirement tax-free. And these extra contribution limits now just mean that people have more opportunity to do that and to get more money into that tax-friendly environment. So a welcome change, and definitely positive.
Absolutely. And I mean, I think it'd be lovely to see those good old days of no limits or ridiculously high limits come back. But I mean, I think that's probably wishful thinking. So yeah, I mean, particularly for expats, if we've accumulated wealth offshore and we're trying to find ways to bring that back into Australia tax efficiently or tax free, super is just such an important one to pay such close attention to. And I think, a lot of expats, I mean, even residents, to be honest, lose quite a bit of sight of super. It feels very far away, or you just can't access it soon enough, so it's not exciting. But being able to get, as you say, 360 into super, that's per person, 720 for a couple, another 110 this year, we're up 940, 950, and we're getting pretty close to $1 million really quickly that you can actually get into super, without a great deal of effort.
Most definitely. And that's the thing. It can be so tax friendly once you're back here in Australia, especially. Maximum tax and super being 15%, top marginal tax rate 47%, including Medicare. So massive potential for tax savings. The other key thing to note too is from July, super guarantee rate will be increasing. So if you are paid from an employer in Australia, they are legally obligated to put money into your super. That will be 11.5%. And then next July, it's stated to go up to 12%. So if you make $100,000, from July to be $11,500 that would go into super, and then the following year, $12,000. So again, another positive there for everyday Australians.
Absolutely. Well, look, on that note, we might dive straight into our interview today. I've got a fantastic guest speaker, obviously, Australian expats, Australian residents. When it comes to money, one of the things we sadly cannot avoid is tax. So absolutely delighted to have an international tax expert joining us today. We're going to be covering a lot of topics to do with Singapore, to do with Australia, but even just Australia and international tax. So plenty of questions we're going to go through. I'm sure there'll be a lot of value for our listeners. So let's cross straight to our interview and dive right in.
Let's get into it.
Now, we are absolutely delighted to have with us one of the renowned international tax experts, Matthew with CST Tax. Matt, huge thank you for joining us and giving us your time today.
Jarrad, you're too kind to be with you.
Just by way of background, to give you a bit of an idea of who Matthew is, who is CST Tax, and why are we talking to him today and why we're so delighted to have him join us. Matt is a chartered accountant, over 25 years experience, both in Australia and international tax, working with clients in all sorts of international tax compliance matters, whether you're setting up a multinational business between Australia and overseas, or you're an expat family taking an assignment in Singapore, Hong Kong, wherever it may be, certainly the person to talk to. First-hand experience, Matt was involved in setting up the CST office right here in Singapore. We do a lot of work with the team at CST. They're a fantastic group, look after quite a number of our clients when it comes to all things tax in Singapore. So, Matt, on that note, we'll dive right into the questions. As I said, hugely great
Jarrad.
time today. I'm sure our listeners are going to get a lot of value out of it, but let's dive in. So
let's dive in
with, I guess, the absolute basics.
Yes, indeed.
That individual, couple, move to Singapore, they're Australian citizens. What do their actual tax obligations look like? So they're just your run-of-the-mill PAYG employee. Yeah. What do they need to think about?
Well, look, technically, from a tax point of view, once you become a non-resident of Australia, which is a key point we'll circle back to probably later on in the podcast. But once you become a non-resident and you're in Singapore and you've got your employment pass or your entree pass or whatever permission you've got to live in Singapore, you only need to pay tax on a relatively small category of income in Australia, and that is anything which we consider to be Australian sourced. Now, that concept of what's Australian source, it's more like an English common law type matter, but basically the obvious examples are rental property income. So if the couple you're talking about, Jarrad, still owns an apartment or a home in Australia and they're renting it out, that income being Australian sourced rental income, as we say, is taxable no matter where the person lives in the world, irrespective of tax treaties or anything like that. And of course, you get to claim all your expenses, your normal sort of property expenses against that rental income, and you pay tax on that. The other categories of income commonly that people have are bank interest from savings that they might still have in Australia. You pay 10% withholding tax on that, but you've got to tell the bank that you actually don't live in Australia anymore. Make sure they've got your tax file number. But yes, that's a flat tax that you can't claim any deductions against, right, if it's bank interest. And then you have dividends. So you might have dividend income, and that's the other large and common type of income that Australians have, just dividends from whether they be private companies or whether they be dividends from BHP, for example. You'll have to pay tax on those dividends if they are what's known as unfranked. Now, if they're franked dividends, you don't pay any tax at all. So those are the areas where those are the main types of income. You may have clients, Jarrad, that receive different types of income, and there may be many different types. They might still have a business in Australia, and therefore the income might be connected to that business or connected to an office in Australia. There might be royalties that are coming out of Australia, or more unusual types of income than those three that I've mentioned. But that's generally what it is. So the managed funds, of course, is the other one. You can get distributions from Australian managed funds, and certain types of components of income that you get from these managed funds might still be taxable, but that'll all be covered off in the year-end tax statement from the provider. So it usually is quite simple. The big issue is capital gains, which I think we'll come back to later on in the podcast. But yeah.
Brilliant. Very clear. Now, look, I guess one of the other sort of common myths that we hear or statements that floats around is, Australia, just like the United States, they tax everyone on everything. But as you and I and Will know,
we might be heading that way, but go on.
Let's hope not exactly that.
Exactly. I'm just teasing. Don't worry.
As we know,
let's not worry the listeners overly that we're not there yet.
Absolutely. But as we know, we have double tax agreements between Australia and many countries around the world. But if we just look at Singapore in this example, so can you give us some of the highlights of how the double tax agreement between Singapore and Australia works and how that would impact an Australian expat? Let's use our couple living here in Singapore.
Sure. Well, look, the first thing I'd say is most people do not need to have regard to the double tax agreement. So if it's a very simple if you're in a very simple situation where you've left Australia and there's no doubt about your tax residency, and maybe we'll come back to that later in the podcast as well, you really won't need to worry too much about the double tax agreement unless you're still perhaps personally under an individual ABN number, right? Unless you actually are earning business income from Australia. That's probably the most common circumstance. And there may be some people who are still sole traders and have an ABN but might have left Australia and moved to Singapore and still do some consulting work. That would be one example. And what the Australia-Singapore double tax agreement basically provides is that, yes, even though you might do some work and bill a client in Australia, or even though you might fly to Australia and you might be here for a month and you might do a few weeks or a few weeks of work in Australia under that ABN. What the agreement will effectively say is that if, as long as you're a resident of Singapore, and you're not carrying on a business through what's known as a permanent establishment in Australia, you actually don't have to pay Australian tax on those earnings because you're a business but you don't have an office. So in a nutshell, Singapore businesses, whether they're sole traders or whether they're Singapore companies, which of course many Australians have had and still do have in the past, Singapore companies, there is that benefit that Australia says, look, unless you're an overseas business and you're earning some income from customers in Australia, usually unless you've got an office, otherwise known as permanent establishment, is the jargon. Usually there's no tax to be paid. So that's one area of benefit. There aren't many other areas that individual clients, Jarrad, would have to worry too much about, other than the fact that when it comes to residency, then it gets actually quite tricky, and we might come back to that later on because I'm sure you'll get to that juicy question at some point. And then I'll touch base on the treaty again.
Perfect.
We've definitely got lots of questions lined up for you today, Matthew. So I'm sure
we'll.
Look, Matthew, you've been doing this for a while now, and I'm sure you've seen so many clients with different scenarios and different situations. But what are the common misconceptions that you see with Aussies, living in Singapore? What are the common tax misconceptions?
Sure. By far the most common tax misconception, and it's not only Aussies in Singapore, but Aussies living in Hong Kong have also long had this misconception, and it's many people. It's even non-Aussies who perhaps aren't that familiar with our tax system. But the 183-day rule is the biggest misconception. But let's talk about strictly Australians. We do have a 183-day test, as we call it, in our Tax Act. But just so let me just talk about what that test says, and then what the misconception is. So that test says that if you're in Australia for more than 183 days in a tax year, so that's 1 July to 30 June, right? If you're in Australia for more than that time, you are a resident of Australia, tax resident of Australia, unless the tax commissioner would be satisfied that you didn't intend to live in Australia and that you have a usual place of abode overseas. So there's a lot of jargon there. What does a usual place of abode mean? Well, it just means a place that you commonly live, to break it down to its bare essentials. But that's an interesting one because it basically means that if you spend 185 days in Australia, you are a resident unless you don't intend to live here and you also have your usual place of abode still in Singapore, right? Mm. So there might be some people who do fall into that category. The problem with that test is that people then reverse it and they think, okay, so if I'm in Australia for less than 183 days, I'm okay. That's not the case. Sadly, that's not how it works because there are two other tests that people don't talk about as much. So you can be in you can be in Australia for 100 days, 120 days, 150 days, 80 days, depending on the situation, even a fewer amount of days. And that's part of the trouble. There is no actual lower limit. It depends if it's the Australian, it depends on, well, what is the character of their visits to Australia? And when they're in Australia, what are they actually doing in Australia? if they're actually living in Australia, as we understand, that term to be, if you're residing in Australia, because you can have houses in two countries in the modern world. It's an 8-hour flight. Just hop on the A380 and you've had a very easy flight to the east coast of Australia. It's not and even easier if you're on the west coast of Australia. So it's pretty easy to get here from Asia. And the real question is, why is the Australian here? Are they really just visiting, or are they actually living here? They started living in Australia, or are they still living here? They haven't quite left. That's where the grey zone comes in. So anybody who sort of day counts and says, oh, well, I've only done 179 days, so I'm okay. Unfortunately, you're not okay. They've reversed the test. So we don't want to reverse the test. That test is really there mostly it's there for actual non-Australians. So, for example, if you're an overseas businessman or businesswoman and you've flown to Australia and you're in Australia for more than that time, right? We might look at you and say, geez, you spent 190 days in Australia. That looks a lot like residence. But then we'd look at your facts and say, but hang on, you're in the Hilton Hotel, you're in the Sheraton, you popped around, you're in a service department one trip, you were down at Manly the next trip, you don't have a home, don't have a car, don't have family, and you're clearly here for conferences and work. That's not living in Australia. Sure, you're more than 183 days, but A, you don't intend to live in Australia, and B, you've still got your place in Singapore. So that will, by a long way, is the biggest misconception. So the day counting around the 183 days, if you're an Australian, please don't do it because it's a highway to nowhere. And more likely than not, it'll land you in hot water, assuming, of course, that you're selected for an audit.
And we say it regularly to clients on our side. The ATO is very big on your intention. If your intention is to avoid tax in that sense by declaring where you're a resident of or trying to get around the 183 days, if you've got bad intentions, you might get picked up on it. But, if your intention...
Sounds like a rock song, doesn't it, Will?
It does. Well, as I said, though, if your intentions are, I'm here for holiday, I'm here for, for work, then obviously, as you said, there's that leeway there. So
that's right.
When we get, people who have both, like an Australian in Singapore and maybe changing tax residency, like what are the main steps they need to progress through to make sure they are tax compliant both here in Australia and in Singapore in that circumstance?
If they're changing residence.
Yeah.
Well, I think let's talk about the departing case because the departing Australia can be interesting. I think the main things to think about is always start at the fundamentals. You might be physically leaving Australia, but are you actually becoming a non-resident? Because the biggest problem is if you're taking a job overseas and you're counting on a certain after-tax take-home pay, you're thinking about the tax that you might have to pay in Singapore. You're thinking about the tax that you owe, and those rates are a lot lower than the Australian rate. So obviously, if you're assessing a job overseas, clearly your after-tax take-home pay is what you're looking at. Now, if you get that wrong and you're after tax and you're losing, 47% from your tax instead of 20%, and we're talking that, or 22%, talking about the top rates in each country, that's a massive difference. And some people might say, well, if I'm not clearly going to be a non-resident of Australia, if it means I've got to pay Singapore tax and then I've still got to declare my salary to the ATO and pay the top-up Australian tax, then is it really worth me going, right? Because I've got to uproot myself, uproot the family. I might be dragging kids, and I mean that respectfully. We won't drag them through the airport, but you know what we mean. So it's really around, getting the proper planning done before you leave. Am I actually going to become a non-resident? And I have to say, in most cases, that I've seen over the years, the answer is yes, simply because if it's an ordinary situation where you're going overseas to accept a permanent job, you're going to have the legal permission to live and reside in Singapore. You're going to get your apartment. You're probably leaving Australia and selling your car and either renting out your house or giving up the lease that you're in. And you're essentially severing those connections in Australia is one of the things that we always look at. Is the person actually leaving? And you do talk about intention, Will, which is important, but it's very hard to get into someone's mind. I can't do it. The tax office can't do it. Some people don't even know their own minds with all due respect. So it's, and the future's uncertain. So often it's the case of, well, what's actually happening? What do the facts show? So even if someone's not entirely certain about the future in Singapore, the fact that they've left, kids have gone with them, they've sold the car, they've leased out the house or whatever the case may be, that looks pretty clearly like they've severed their connections with Australia. Now, that's probably the most common example. Where it tends to get tricky is if, well, I'm not really going for a permanent role in Singapore. I'm only going for a 9-month stint, right? Or I'm only going for 6 months, or my role is, or I'm in an industry where you don't really have a lot of permanence. Or I'm just going to go over for 3 months and see how it goes. When you're getting into that sort of temporary territory, alarm bells should be ringing because you're probably not a non-resident in the traditional way of looking at it. So the steps really are, before you accept that role in Singapore, talk to your accountant in Singapore, in Australia, about whether you're actually going, in their opinion, going to become a non-resident. Then you can accept that role with a bit more certainty. Your accountant should be able to give them, their accountant should be able to give them guidance on anything that worries them, for example, because some things will worry an accountant that won't necessarily worry the client. And that's only because the accountant might know more about a particular topic, right? It's like in the investment world, people who aren't professional investors, who aren't experienced investors, perhaps don't worry about things in the same way that professionals do. So it's the same thing with tax and accounting. So if your accountant is not worried about you becoming a non-resident, nine times out of 10, you shouldn't worry. If they're not sure, then don't accept that job offer until you've perhaps taken it one step further and got a bit of extra, perhaps more formal advice if your accountant feels that they need to go to somebody else. Does that help, Will, on the departure case?
Yeah, definitely. I think the main points there, it's really getting the people in your corner that you need to confirm things for you, right? To make
Exactly
sure that
right.
Step by step, so you've got people behind you that are supporting you and making sure you are making the right move and doing things the right way.
That's right. And there are consequences of becoming a non-resident beyond just the treatment of your salary. So, and many people will not know this before they accept a role overseas, and then they'll find out later. But I always like to talk about BHP, not because I'm giving a stock tip, of course, but it's just an easy share to think about. So, for example, if you're an Aussie, you live in Australia, you bought some BHP shares at the bottom of the pandemic when they were $28. They've rebounded now to 45. Geez, I promise I don't own any. I promise I don't own any myself, Jarrad. They've rebounded to $45. You're sitting on a nice profit, and then you decide to accept a role in Singapore, and you leave. Family goes with you, or you don't have any family, and you go by yourself. But it's clear that you've left. What Australia does is Australia says, "Okay, Matthew, well, you've left Australia. You've become a non-resident. Those BHP shares that you bought for $28, we're going to deem you to have sold them for today's price, $45, the market value on the day you leave." Now, that might not be terrible if I don't have a lot of BHP shares, but for most people to have to put a capital gain in their tax return and pay tax on a paper gain because they haven't actually sold the BHP shares, is a problem. Either they've got to go and sell BHP shares to fund the tax bill. I don't know. Investments and financial planning, not my area, right? So everybody who's listening, talk to Jarrad and Will on that one, because it's a financial planning and investment question. But you do have to consider this deemed disposal, as they call it, of the investments that you own. And it's not only shares, it's basically any capital gains asset that you might have. You might have a $200,000 artwork that you're taking with you, right? I mean, you don't even have to take it with you, actually. You can just lock it up and leave it in storage. The same thing would apply to that. You might own a villa in Bali. You know, it's an overseas property, doesn't matter. It's still an asset. The only thing the only type of asset that you don't have to worry about this departure tax on is actually Australian real estate. So that's a big advisory area, and we help clients all the time with working out, well, what are we going to do in this situation? Because happily, and again, this is where the financial advice is important, happily you can actually choose not to have to pay tax on the BHP shares. It's a specific election. And if the client decides not to do that, on one view, that's a good thing because, hey, I don't have to pay tax on an imaginary gain. The problem that creates, and this is something that people really do need to take both tax and financial advice on, is that those BHP shares will then always be, quote unquote, taxable in Australia if the client ever sells them as a non-resident. So in that situation of my example, if I moved to Singapore with those shares at $45, I decided I don't want to pay tax when I leave, and I sell them 10 years later and they're worth $60, then I've got to pay capital gains tax on that entire gain in Australia. And even worse, I won't get the full 50% capital gains tax discount, which we might talk about later in the podcast. So departing Australia does come with those consequences, and also comes with a few other consequences around domain residence, which we shouldn't forget to cover later on.
Mm.
Yeah.
Look, let's go down that rabbit hole. I think
Okay.
the deemed disposal is an area we could just talk for so long about it. I mean, so many
Absolutely.
expats we meet, first they've never heard of it, and then, oh my goodness, you can elect to do it. So such an important one to seek, as you say, Matthew, both tax and financial advice.
Absolutely.
But definitely speaking to your accountant, and especially an accountant who understands expat and residency. But let's dive into the property. So you mentioned this, so let's have a look at Australian residential property.
Yeah.
I guess we've really got two key forms for expats to be aware of. So one being the main residence, so the family home, they've lived in it, paid down the mortgage, like every good Australian household should, with non-deductible debt.
Very good.
Sure. And now they're renting out that property. So what does that couple, that individual need to be aware of owning that Australian house that's now generating rental income whilst they're living, working in Singapore as tax residents of Singapore?
They need to be aware that the law changed a few years ago, unfortunately. I won't hide my true feelings on this, Jarrad. I think it's manifestly unfair what the Australian government did. It's, in fact, shockingly unfair. It's extraordinarily bad policy, but unfortunately it was done, and despite the best efforts of the tax profession, the opposition at the time, and some significant lobbying on behalf of expat groups, the government at the time did not change its mind. So now, unfortunately, what that means is that anybody who leaves Australia, keeps their home, rents out their home, and then decides to sell their former home while they are non-resident, they have to pay full freight Australian capital gains tax on that property, even though it was their home and may have been their home for 10 or 20 years. You don't get any credit, if you like, for having lived in it as your main residence. So if you contrast the situation for an Australian living in Singapore with an Australian who might, for example, leave Sydney and move to Perth or any other city, vice versa, the Australian who leaves their home to go and live in another Australian location and rents out their home can always treat that place as their main residence. And yes, there's a 6-year rule which we can come back to, but the point is, they can sell it and they can still get the credit for the fact that it was their main home, and on most occasions they won't pay capital gains tax. But the fact that you've left Australia in the alternative and you're now living overseas, that actually creates the problem. So for an Australian that becomes a non-resident, it doesn't matter where they live, whether they're going to Singapore, Hong Kong, America, the UK, it doesn't matter. It's the mere fact of becoming a non-resident and selling your former home while you are a non-resident. That's what will create this massive tax problem. And of course, I feel it's manifestly unfair because most people's savings are in their home. And to put an Australian who's just become a non-resident at such a disadvantage to the rest of their Australian peers, I think is unforgivable. But unfortunately, fairness and tax sometimes doesn't go hand in hand. It's just something that we all have to deal with now and help our clients with and advise our clients about. But it comes back to the key point. Don't sell an asset that large without taking advice, right? Don't sort of think, oh, but wasn't it my main home? I mean, it's very hard. If people haven't heard about it, sometimes they'll just make that presumption. But, I think that, I guess that's the main point. Get advice before you do anything material, particularly with a property in Australia. Yeah.
Absolutely. This is, I think, one of those moments where a little bit of information can be an incredibly dangerous thing, and arguably nothing better provides an example of that, of selling a property, such a large expense, the fees, the dollars involved.
And it's peculiar because the law allows you to. The law basically says that if you come back to Australia, as many Aussies do, and become a resident, as most Aussies do, to be frank, and become a resident again, then if you decide to sell that place, then yes, they'll give you the credit for the 10 years that you lived in it. So the strange thing about this measure, that change to the law, it was said it was supposed to be a housing affordability policy, and that was the whole problem. And there was never any evidence or research done when the policy was brought in to show why this would help with housing affordability. If anything, all it did was it created a lock-in effect, because people decided, well, look, I'm not going to sell my home just before I leave. Some people did, but I'm not going to sell my home before I leave because most Aussies have a good gut feeling that the Aussie property market's done so well. But they worry that if they sell, are they going to be able to get back in, right? So it actually created a lock-in effect, and I'd argue that was counter to the so-called housing affordability objective. I mean, it was just unfathomable. No one could understand why it was supposed to help housing affordability, but that's what was said.
Sounded good at the time.
Well, I think it was really targeted to foreigners.
Yeah.
Non-Australians. I think that was the real issue. But politically, we don't seem to do that, and maybe we can't do that because of non-discrimination agreements that we've got with other countries. So politically, it's good to get up there and bash. It was easy, I should say, not good. Politically, it was easy for the government to get up there and bash foreigners. But of course, when it comes to actually writing the black letter law, lo and behold, it was Australian non-residents which include all those Australian expats. So it was pretty bad. Now, the Labor Party's got a terrific opportunity, Jarrad, if they listen to this podcast,
Let's hope so.
Right the fairness ship and repeal these laws, because it is within their power to do it. And they were in opposition at the time, and they did do a good job of looking after at least the worst aspects of the policy, because when the policy was first brought in, they hadn't thought about, well, what happens if an Australian passes away while they're overseas, right? Or there's a divorce. So a lot of those things were addressed, but the fundamental problem is still there. And I would, if I was the Labor Party, I'd set myself up as being the champion of the Australian expat, and I'd get that repealed.
Well, we would certainly welcome that conversation and look forward to reading that headline.
Indeed.
Well, look, changing gears a little bit. I mean, one of the other things that I think far too many Australian expats simply ignore, forget about, lose sight of, or again, as you earlier pointed out, take a little bit of information that they hear that leads them down the wrong track. Superannuation. So I guess at the very basics, can Australian expats contribute? Should they consider it, or is it just something they should ignore altogether?
I think that they should follow the advice of their financial planner, as ultimately that is the key. But the simple answer on the tax front is there's absolutely no problems at all with an Australian expat contributing to Aussie Super. They don't, of course, have to do it. So everyone's financial circumstances will dictate whether it's important. Now, having said that, in terms of whether or not you can actually get a tax deduction for contributing to Aussie Super while you're away, again, depends very much on your situation. Now, many of your listeners might know that there are these so-called caps on limits on what people can put into Aussie Super and get a tax deduction for doing it. The jargon that's used is something known as a concessional cap, which no doubt you help your clients with. But for the listener, you have something called the concessional contribution, which is a contribution that either you make or your employer makes, and you get a tax deduction for that, in essence. Then there's something called a non-concessional contribution, and I'm old enough to think of those contributions as what they were called. They were called undeducted contributions, and now they're called non-concessional contributions, and no one can fathom why we had to have a change of lingo, but we did. And so there's two different types of contributions. If you're wanting to make a contribution and get a tax deduction, you have to, of course, it's important, of course, to stay within your deductibility, to stay in that in the cap, which is $27,500, unless I'm out of date already. But that is the key number. But the point being is you've got to have enough Australian income to actually use that deduction. So if you've only got $10,000 of rental property net rent left, you can't put $20,000 in, but you're not going to throw yourself into a $10,000 tax loss to use those numbers. So you'll only get a deduction for the amount of the actual taxable income that you've got in Australia before you apply your super deduction. But the broader question is, yes, you can contribute, and I'd argue that you should seriously consider contributing because, upon advice, because the issue that people often find is that they might not contribute to Australian super for many years. And if they come back after many years and they don't have much in Australian super, then with all these contribution caps, the question then is, well, how do I get money into it? And it's not very easy to do. What sometimes can happen is that the Aussie abroad ends up building up savings in a foreign superannuation or retirement fund. Now, way beyond this podcast, just for reasons to do with time, but there are certain overseas retirement or superannuation funds that are recognised as such by the tax office, and they generally have quite good tax treatment when the Aussie decides to come home. But there are others that aren't recognised in the same way by the Australian tax office. And then if the Aussie comes back after many years abroad and has a lot of savings tied up in something that Australia doesn't recognise as a super fund, it can actually be quite tax detrimental getting your money out for technical reasons that people will find out if they take advice on the point. So that's what I'd have to say about Aussie Super, Jarrad. I'm totally with you.
Very helpful.
We're big fans of superannuation, that's for sure. And big fans of reducing tax wherever we can.
Look,
as well.
I have to say, for all the tax laws that Paul Keating brought in, capital gains tax, fringe benefits tax, and a lot of taxes that were complicated in Australian international tax, and I do a lot of that, control foreign companies and rules to do with how Australians are taxed on foreign trusts and foreign companies that they might have. For all that complexity, compulsory superannuation, I would say he's, that government, has clearly changed the lives of many Australians in retirement just by making sure we had that system. So I'm with you on that.
Mm. And look, talking about systems as well too, obviously Australia and Singapore, our tax systems are quite different, especially regarding personal income taxes. You already touched on the different top rate, but also capital gains tax quite different as well. Do you want to run us through the main differences there?
Sure. Well, the main difference really is, I suppose it is a bit like paradise for an Australian, Singapore, in many ways, as we know.
Don't tell everyone.
We won't tell everybody. The beautiful city, the gardens, the lifestyle, that's all fantastic. Having lived it, I'm very happy to reminisce. Perhaps on another podcast, guys. But basically, Singapore doesn't have a capital gains tax. So it's a lot like New Zealand that still doesn't have a capital gains tax. So, and that's just a broad exemption. It isn't on particular classes of assets. It's on all assets. So Singapore doesn't have a capital gains tax. Singapore doesn't tend to tax much investment income at all. There might be a very tiny class of investment income that Singapore taxes, but it wouldn't be much. In fact, I can't remember what it would be. So mostly there's no tax on any investment income. So that for that reason, people sometimes do say, "Oh, but why would I send money into my Australian super fund where I might be paying some tax if I could put it in something in Singapore and actually pay no tax on any investment income?" Well, it comes back to the point that we discussed earlier, which is, well, you've got to think about, yes, okay, you might be better off in the current year, marginally, but you've got to plan for your return to Australia, right? So, but yeah, no, Singapore has no capital gains tax and not a lot of other tax, so it's a pretty good place.
Mm. And yeah, planning definitely is a key thing there as well that you've said too. Do you find that there's I know we touched on a lot of the common misconceptions people have, but do you have any tips, I suppose, for avoiding, the pitfalls when it comes to planning, when it comes to the compliance side of things of doing your tax in Singapore?
Look, absolutely. Not so much Singapore tax per se, because it's so simple. Most people can actually do their own Singapore tax without doing CST out of a roll. Always feel free to come and see us in Singapore, but it is very simple at the personal tax system. I don't often find mistakes made there when it comes to personal tax. What I find is most Australians, once they get to Singapore and once they see wider opportunities in Asia, as is so common the case, they might decide to, buy investment assets either in Singapore or around the region. And it's not so much a mistake to do any of that. It's probably great. It's probably good to do all that. The issue is, have you thought through what happens when you return to Australia if you're buying an asset that you can't easily restructure. So if you're just going to be buying shares and investments and it's fairly easy to change how you own those things with a minimum of hassle, that's fine. But if you're going to go and buy a villa in Bali or Thailand or Niseko or enter into some long-term property investment, or you're going to do a long-term life insurance bond or whatever it is that you're going to do, you've got to think around, well, what do if I'm still owning this thing when I arrive in Australia, what are my inbound tax consequences? If I've got a mate who's telling me about a hedge fund in the Cayman Islands and it looks really good and I invest into that, well, what happens if in 2 years I'm back in Australia and I still own that hedge fund investment and I pull some money out? How is that going to be taxed? And is it going to be taxed the way I expect it to be taxed? What if I set up a company overseas or I've got a business overseas? People should be thinking about, well, what happens when they return to Australia? And so a lot of the mistakes, quote unquote mistakes that I see is just simply people don't spend enough time thinking about planning their return and getting a sort of a tax health check done, if you like, of their financial circumstances. And then they're back in Australia and then they realise, oh, in the rush to get home, kids, whatnot, life, people get busy, hadn't thought about the tax angle. I mean, that for an Australian probably is a cardinal sin because we tend to try and tax everything, as I'm sure you know, except the main residence and, for most of us. So that's the point. And often you find that people will come back to Australia and they might have an investment overseas that they thought if they ever sold it, they were going to get capital gains tax treatment on. It might end up being just income, meaning that they're paying tax at higher rates than they might have expected. So there's all sorts of stuff, Will, where, and I think it very much depends on the person's circumstances. And I think if they're clients of yours or soon to be clients of yours, hopefully, you'll probably tell them, look, you've got a complex situation, you need inbound tax advice. Now, it can be their accountant, doesn't have to be CST, I'd love it to be, but if their accountant is capable of doing it, that's fine. It's just got to be someone who is used to thinking about how overseas assets are taxed in Australia. And Will, the other trap, which is a big one, is we've got some fairly ugly rules about foreign currency. They're not well known at all, and they produce some absolutely crazy tax results. The nub of it is that if you're an Aussie and you've got more than 250,000 Australian dollars in actual foreign currency sitting overseas, right? Or you've got a loan of that amount, or more than that amount. You've got to realise that when you come back to Australia and you've still got that bank account with HSBC or DBS or whichever bank you're with, using that money can create a taxable gain in Australia, depending on which way the exchange rate moves. You might even get a loss out of it, which is nice because you can claim the loss. But most people don't realise that issue is there. They then come home, they then move their foreign currency around, and then lo and behold, at tax time, they find out that they triggered exchange gains just by moving their own money around. And the laws are so crazy that you could move $500,000 Singapore dollars from one Singapore bank to another Singapore bank. You haven't actually changed currencies. But if you're a resident of Australia when you do that, you're actually triggering an exchange gain or loss. So there are some traps to watch out for, definitely. And then it's also the timing of someone's return, Will. That can be important, but we might get to that later.
I think you touched on it pretty good with the phrase that, in Australia, we like to tax everything. I think in that foreign exchange, the currency is just obviously a great example of that.
Another example of it. Yeah, exactly.
Absolutely. And I mean, I think you've hit the nail on the head so many times, Matthew, thinking through the return to Australia, that is key. I mean, Singapore's a lovely little paradise. Gosh, I mean, this is year 11 for me. We have no plans to return. I also know I'm
Fantastic.
not going to retire here. We will retire in Australia at some point. Australia is, where the family is, where life will one day be, and we need to think through these assets. And that then comes to, well, these offshore retirement plans and vehicles, one of which in Singapore, as you know, is the CPF, which for permanent residents or Singapore citizens, they will contribute to CPF, but it's not the same as superannuation.
Yes, indeed.
So I guess for an Australian or even a Singaporean perhaps who might be moving to Australia, they've got CPF. What do they need to be thinking about in terms of tax, moving money? What does all of that look like?
Yes. So what they have to think about is that, or be aware of, is that even though there are no public rulings from the Australian Tax Office, and that's important, and I might just talk about what that means for 30 seconds. A public ruling is a document that the Tax Office issues to the public at large, and it is their considered binding position about a particular issue. We don't have such a document in relation to how Australia would tax the CPF, which is a shame because there are so many Australians that probably do have accounts with the CPF and are back in Australia as residents. Similarly, if we're talking about the Hong Kong MPF, it's the same thing. That issue is even manifest, quite frankly, for certain US retirement plans, 401ks, IRAs. It's all over the place. That issue is, but strictly speaking, what we understand to be the ATO's, shall we say, preliminary view, is that the CPF is not considered to be a foreign superannuation fund. Now, that's a shame, given, we're quite familiar with the CPF. We know that it's mandatory, and clearly we know that it's a retirement fund. But for technical reasons that we won't go into, that's not how it's seen in Australia. Now, the Tax Office probably doesn't have a lot of choice in how they approach it. They have to administer the law as it's written. There have been court cases, not specifically about the CPF to my knowledge, but generally in relation to overseas retirement funds. The Tax Office has to follow the judicial reasoning, and applying that judicial reasoning, they do get to this position. So it's not as if the Tax Office is out there trying to, just levy tax willy-nilly. It's the way the laws are written, right? If we had a government that was more willing to think about expat affairs, the laws could easily be changed. But that doesn't seem to be the case, and it's not a particular criticism of the current government. It's a criticism of all Australian governments. Sadly, the Australian expat, out of mind, out of sight, out of mind. Hopefully that can change, and our policymakers can circle back and realise what an important part of the Australian community the expats are. But the nub of it is the CPF is probably going to be seen as a foreign trust, not a overseas superannuation fund. As a result, a person who's back in Australia and taking money from their CPF fund probably has to declare that as taxable income in Australia. And what they have to do is they've got to get the records from their CPF records, and they've got to work out what are the contributions versus what are the earnings in the CPF, because you're not usually taxable on the contributions. Usually the interpretation is that if you take out $100 from your CPF fund, part of that $100 should be relating to your contributions, and part of it probably relates to earnings. It's the earnings component that would be taxable. Part of the problem with not having any public guidance on the topic is that we don't exactly know what approach the ATO would accept to declaring the earnings component. So would they be happy with just a simple apportionment approach, which we all think is reasonable as tax practitioners? Do they want the earnings to be declared first? Can we say the earnings are coming out last? It's not well known. Now, we might be getting guidance from the tax office on the point. I think in the next few years is the rumour I've heard, not particularly about the CPF, but about the broader issue of people that want to repatriate funds from these foreign trusts, and they consider CPF to be one of those. So the other thing about that is there is a open question as to whether or not people actually have to pay an interest charge on it, but that's again something that's very few people are aware of, and we're not even sure that actually applies. So it is, and whether that will be applied by the tax office. So unfortunately, Jarrad, there is no real certainty other than, I guess, plan for the worst.
Mm.
And if you plan for the worst and you get a better result, then, we've all done our jobs.
Mm.
Absolutely. No, it makes an awful lot of sense.
Now, if you can take your CPF before you leave, Singapore, that might help.
Mm.
But on one view of the law, you need to try and take it before the start of the Aussie tax year that you're going to become a resident, and that might not be easy.
Definitely timing and appropriate advice, very critical to any move.
Yeah.
Now, I guess one of the other sort of common areas that we see, or, as you mentioned earlier, Australians come to Singapore, they see opportunities in Asia, maybe they've already got businesses in Australia, they're trying to expand. Maybe just at a high level, can you sort of step us through some of the, I guess, benefits of running, setting up, establishing a business in Singapore, and I guess even, the role that CST plays in helping those
Sure,
Singapore?
I'd be happy to. Thank you. So Singapore is just a great place for most international businesses to set up. It's built its reputation on that as a regional centre, as a global finance capital. The reasons for Singapore's attractiveness is several-fold. I won't do the job of the EDV in going through each of them, but certainly from the Enterprise Development Board, I believe. And also, I believe there's Enterprise Singapore, which I think is more at the SME level, more to help Australian SMEs move to Singapore. But you're looking at the fact that Singapore as a legal system. You've got that certainty. You've got English common law at the heart of it. You've got the English language. You've got concepts of capital and income that most Australians are familiar with. You've got an excellent bureaucracy. It works, right? Compared to many other places that perhaps don't work as efficiently. You've got certainty. You've got rule of law. So all those advantages. On the tax front, you've got a very wide tax treaty network. There's a tax treaty with Australia. There's a tax treaty with many of Singapore's major trading partners. There's a treaty with the United Kingdom. So those treaties can be very useful in just making sure that the business that person setting up in Asia is not double taxed if it's expanding elsewhere using Singapore as a base and expanding into Asia. It's very useful for clearly working out what rates of withholding tax you might have to pay. You get lower rates of withholding tax because you've got a treaty with another country, and usually you'll have higher rates if you don't. So for all these reasons, Singapore is important. We advise Australian businesses that move to Singapore all the time, mostly on the Australian tax issues of owning an overseas subsidiary and how those profits then get repatriated to Australia. What the implications are under the Australian CFC rules, and that's just a bit of jargon there. But Australia will sometimes take the view that the type of income that's being earned offshore should actually be taxed in Australia as it's being earned. That doesn't happen all the time, but it happens in cases where there isn't a real business. But for people who are carrying on a real business, it's more about, we advise on perhaps how that business might be owned, withholding taxes, cross-border funding arrangements, how to capitalise the business, all sorts of things. Yeah.
I've got a question based on, a bit of a scenario. So let's say you're an Australian living in Singapore, you're contemplating returning back to Australia at some point in the future. You don't know when it's going to be. What are some key pieces of advice that you would give them in that scenario?
If they don't know when it's going to be, well, I think I would probably say don't worry too much. But I think if you're a year to 6 months out, if you're fortunate enough to have that much planning time, that's when you should be having a conversation with your advisors around thinking about a return. Your accountant, your financial planner, that's really the time where I'd start. I think one of the easiest return issues to overlook is timing. And if you're employed, what people have to keep in the back of their minds is the timing can get critical, because if they're going to receive a payment from their employer after they've returned to Australia, that unfortunately 9 times out of 10 is going to be taxable, even if they've actually done the work in Singapore. So many people are surprised to hear that even though they spent the whole year in Singapore, for example, and they left to come home in December and their employer pays them a nice bonus in March, people think, but hang on, that bonus related to the work I did last calendar year when I was not an Australian resident. Why am I having to pay tax in Australia? So I think, Will, the short answer to that is timing is the most critical thing. Talking to your advisors early and thinking about what type of income do they earn, when are they likely to receive it, is probably the most critical thing. Shares and investments, there's no sort of dire need to sell things before you return to Australia. Usually because in a rising market, nice assumption, I know, but usually in a rising stock market, if you'd bought, flip the example, if you bought your BHP shares, I should use another stock, shouldn't I? If you bought your Rio Tinto shares, this is me giving stock picks, which I promise everyone I don't do this for a living.
It's all right. We gave the general advice warning at the start.
Excellent. If you bought your Rio Tinto shares when you were a resident of Singapore and they were $90, and you moved back to Australia and they're $110, Australia will say, okay, well, on the day that you returned, we'll give you that $110 market value as your purchase price. So that $90, that $20 gain that you've made will never be taxed in Australia if you own it personally, right? It's where you own those types of things through companies or trusts that things get a lot more complicated, and probably the subject for another podcast, I'd say. Yeah. So I think those are the main probably returning issues, I'd say.
Yeah. So timing's key, really, in that sense.
Timing is key. Yeah.
So what resources or services would you recommend then for, Aussies living in Singapore? Is there anything that you direct your clients too?
Yeah,
Bit of reading?
if they're interested in seeking advice from us, we provide a written advice, and honestly, the only advice that's worth getting is written advice. A lot of Australians can sometimes be advised through their arrangements that they have with their employers. We find that advice often misses things. Often it's not written, and often it's not comprehensive. And for particularly people that are in complicated situations, you've got to get written advice, only because tax is confusing enough. But if it's not locked down in a memo that you can look at and plan around, things can get ugly, things can get messy, mistakes can be made. So getting that written advice is really important. We offer it in two main ways. We have some fixed fee services for clients, returning to Australia type services. It depends on the level of complexity and the level of time that we think we'll need to take to sort of analyse the client's affairs. But normally that process works very well, and it provides a level of certainty for everyone in the family, for the client's financial advisors, and yeah. So generally, that's the service that we offer. It is comprehensive, it is expensive, but the good news is, Jarrad, it is tax deductible. So we'll happy to help, and the fact that it's tax deductible means it's often cheaper than the advertised price.
Always a plus. Always a plus.
Always a plus.
Excellent. Well, look, Matthew, we might wrap it there. As we've kind of touched on, there are so many other areas we could explore. So we definitely have to have you back.
Lots of areas, and a general offer for clients of yours. I'm happy to have an initial call with. They would have to be clients of Jarrad or Will, and demonstrably so. It's not an offer for the whole Australian expat community. Otherwise, the phone would never stop ringing. But no, thanks for having me on.
Very grateful for your time, Matthew. You've been huge amount of value for our listeners. So I'm sure everyone's going to get a ton of value out of that. Very grateful for your time.
A pleasure, guys.
Looking forward to seeing you next time. And obviously working with both your team with CST here in Singapore and down in Oz.
Thanks. Have a Singapore sling for me, Jarrad.
Absolutely. Thanks very much,
Cheers.
Matthew. Cheers.
Thanks, Matthew.
Will. Thank you, Will.
Bye.
Take care. Bye. Thanks, everyone.
Well, definitely a lot of gold nuggets in that conversation with Matthew from CST. I know that's probably one that I'll go back and re-listen to myself. He said lots of points there that I think I want to rehear and relearn. Definitely with the tax complexities, it's always a topic that you can re-listen to and relearn, and you might miss pick up on something that you've missed previously. So really, really great episode. I thought that was. Look, as mentioned, previously on the podcast in our first episode, we will be releasing these podcasts every single month. We'll be interviewing an expert with every single one. So there's going to be lots to listen into for the future as well. And you can find the podcast on all major hosting services, Spotify, Apple. I believe we'll be uploading to YouTube and whatnot as well too. So anywhere you listen to your podcast, you'll be able to find us.
Absolutely. Thank you, Will. So look, guys, if this does appeal to you, make sure you check us out on the socials. We are at Money Side Up on LinkedIn, Instagram, Facebook, X, or Twitter, depending on your preferred terminology there. And of course, YouTube, if you'd like to check out the video. And of course, all the podcast channels, as Will mentioned, depending on whether you prefer to absorb information audio or check out the video as well, depending on how you prefer to learn. So look, huge thank you for joining us. Don't miss next month. We've got another great speaker lined up. Plenty of value. I'm sure there'll be plenty of gold in that one as well. Very much appreciate your time. Looking forward to seeing you in the next one. Thanks for joining us today, Will.
Until next time, guys.